Good morning. Oh my gosh, this morning is so much better than last week's morning, wasn't it? We're Mortgage Pros 411. I'm Audrey Boissonou. This is Kevin Casey, my co-host, and we are joined today by the wonderful Bill Loman. Smile, Bill
Hello.
Loman.
Hi, everybody. Great to be here. Always an honor.
You're the sweetest. All right. So as always, there's a few things going on out there in the mortgage industry. We're always blown away by the fact that on a week basis, we run out of time before we run out of topics. Like it never stays the same, right? Okay, so there were some interesting things happening this week, as always. So I didn't mention this to you, Bill, sorry. City National, there was they were fined $31 million, 31 million, that's right, by the Justice Department for redlining. So they were found to be systematically avoiding lending to racial and ethnic minorities. And the reason I think we need to talk about this, other than the obvious, which is why in 2023 are we still redlining? Why? Why?
Yeah.
You have an answer? No? Okay. So, but I hear these discussions when I'm hearing coaches speak to LOs, and they start saying things like, well, if you want to increase your business and your income, then just focus on the areas with a higher loan amount in the right?
Yeah.
You have to be really, really careful with that, because we listen to the regulators, and they're looking at these things big time. They really are all about fair housing, make sure that we're reaching the underserved. And it is not okay to just go, all right, I'm only going to do $1 million loans.
Yeah.
Can't do that. They're looking at it. Bill, any thoughts on that?
Slippery. It's a slippery slope.
Right.
So, American Pacific, we do business with City National Bank. Let me back up. I think that you really companies need to examine their business models to make sure they don't get themselves in harm's way. City National, we have a warehouse line with them. They've been a great partner, so I don't want to, say anything disparaging. Their business model is they're down in Southern California, banker to the stars. So they're seeking high net worth depositors, and typically banks will make loans to their high net worth clients. And, I think that's their business model, which led them on this path. And look, I think that, this is why Wells Fargo, and I know we'll touch on that here at some point, but this is one of the reasons why I think Wells Fargo got out. I mean, you couldn't go a week without Wells Fargo getting hit for something. And I'm not saying they're not guilty. That's not my point here. I think most recently, about 3 weeks ago, they had a $7 billion fine from the CFPB. And that was mainly on consumer and auto lending practices, but they had a target on their back. And I think at some point they're like, screw it, like we're out.
Yeah.
And that's, I think the city, City National, Wells Fargo, you name it.
Well, we have a small regional bank in our area that is very much focused on the higher end. And I keep waiting for them to get, their reprimand, how shall we say. But we did hear, so Kevin and I were in Florida last week for the NAMB conference for NAMB Focus. It was a really good event. There were a lot of interesting speakers, but one of them was the federal Florida regulator. And so what is going on in one state is often going on in other states as well. So there were a few tips in there, because there are exams going on constantly, right, across the country, whether it's a state or federal. And so there were a few takeaways for the brokers in the who are listening. So first of all, if you get an exam notice, read it thoroughly. I thought it was interesting they would note this. There must be something going on with that. Read your exam notice thoroughly. Make sure you respond. You'd think that's a no-brainer, but apparently not. and be available when they want to do the exam. And this was the funniest part to me personally. Take a look around, make sure you don't have some other illegal operation going when they come in to do the exam. So for instance, if your office is beautifully decorated with pot plants and that's illegal in your state, perhaps relocate them before the examiners get there, because apparently they're sharing information. So the mortgage person comes in, they're going to do the exam. They're like, oh, wait, we have a pot operation here. That's illegal. I'm going to call someone, and they do. So it's crazy. Like, that
No,
be hello.
that's all really good advice.
Thank you.
And I
Wasn't
think
for me.
that even taking it a step further, if anybody here or your companies get involved in an exam, you know, it's like make sure you're not leaving any shit laying around. Like, you know, that's confidential stuff. That when you leave, you lock the doors. That, you know, you're taking care of private data that you may have on your desk, in your file cabinet, or whatever it is. There's just a whole, you know, string of things that you need to make sure that you do. We had prepared a long checklist like that before our CFPB audit. You know, people thought I was being a lunatic, but all this stuff matters. It all matters. So that was really good advice by that person.
It is. The other thing that was important, I thought, was they talked at length about social media. They're watching it. They're watching social media to see what we're all doing. And guess who's there also hanging out there if an LO screws up? The broker. So the brokers need to be aware of what their LOs are up to on social media. And that could be something as simple as, you know, posting that a realtor gave him some tickets to a football game, and thanking the realtor online. I mean, you're going to have a RESPA issue, right? So there's so many ways to get into trouble if you're not paying attention. So for God's sake, pay attention.
Yeah, and I will just say, for any of our folks on this call that are from the great state of Washington, and we have a great relationship with Washington DFI, but they're watching.
They are. Washington's the state where a few years ago they were busting LOs for meeting clients in Starbucks and not having a secure location or a licensed location. So you've got to be aware of these things and make sure that you are sharing them with your LOs if you are a broker, or your LO. Well, share them with everyone, because you know, honestly, you could probably have a processor and get you in trouble there too, right?
Yep.
So
exactly right.
Good Lord. All right. So I love that Bill and I had a conversation about what we were going to talk about, and I hit him with something that was not even on the list right out of the gate. So
why do we even have that conversation?
So let's talk about cash out fees that are now embedded in Optimal Blue in our pricing engines and are making our lives, let's say, more challenging. So, you know, there was a push to FHFA to say, hey, you know, why are you doing this? This isn't good, blah, blah, blah. But to no avail, it would seem. So are the cash out fees, extra fees, here to stay?
I think so. I think, you know, the stated purpose of doing that, or it was part of a broader strategy to subsidize affordable. And so here's the interesting thing. We got the fees. We haven't seen much of improvement in affordable. There was some that was announced, but you know, so the other side of the equation.
That's shocking. That's just shocking. I'm so surprised by that. I mean, I didn't see that coming at all.
Yeah, no, I mean, you raise the fees, so now you don't do any cash out refinances through Fannie Freddie, and you go, you know, private sources like, you know, private banks, because it's cheaper. And therefore, they don't get the fees, and regulators just don't get that.
That's exactly right. So when they, you know, you do that, whenever they've raised fees or raised LLPAs with the intention of creating a cross subsidy, you don't create it, because the loans go elsewhere. And to a degree, I don't think that bothers the agencies. I think they're trying to get a little tighter on what the mission is. And so I think they're here to stay. I hope I'm wrong, by the way, but I think they're here to stay.
I really hope you're wrong. But I feel like there's a real disconnect within the agency, within FHFA, with regard to, okay, they're saying that their mission is to serve the underserved. I wish I had it in front of me. I have it somewhere. serve the underserved and take care of this. But meanwhile, they pump up all the fees everywhere. They lie about, about reducing the fees. And
Anybody from the call from FHFA, the views of Audrey don't necessarily reflect the views
Whatever.
of me or American Pacific Mortgage. Go ahead.
whatever. Okay, so here's the thing though. It is what it is. So explain to me why I'm wrong. So they say one thing and then do another. So it makes no sense. Even when you're talking about the investment property fees. Okay, maybe the second home should be a separate subject. They should be a separate subject. But investment properties, when you make that more expensive for investors because they're so rich, apparently, it trickles down to the renters. And
Oh, absolutely.
that's why, I mean, 39% of it's CPI is shelter costs. Okay.
Right.
39%. So if you've got a huge amount of an inflation number that is being driven by shelter, and then you've got FHFA, which is supposedly helping to serve the underserved, and they're pumping up the number. It's so disconnected for me. I wish someone could make sense out of it for me. Maybe I'm just stupid. I don't know. But
yeah, no, you're not. I think sometimes, it's hard to understand the wheels of government in action. But that has definitely played a role in driving up rents.
Well, because now anybody who's like apartment loans that are maturing right now, they're facing a huge jump in costs.
Yep.
And so a lot of them are either, selling or, now they're just, absorbing the cost, but they have to pass it on to the tenants.
Yep.
that's right. Well, and CoreLogic's rent survey just came out, and it was up 7.5%, which sounds terrible, except a year ago it was up 18%. So it's coming down. The shelter cost is coming down, but again, because it makes up such a large part of one of the major inflation numbers that we look at when you're looking at, how's the economy doing, et cetera, it's an issue.
Yeah, and it's not really coming down. It's just going up at a slower rate.
Right. Fair enough. That's a good point. A really good point. So I wish we could get some connection between what they're doing and how it trickles down to the consumer. And, we keep trying to send that messaging, but it's frustrating to say the least.
No doubt.
All right. Well, on that note, although it has nothing to do with FHFA directly, credit report fees have gone through the roof, and we're seeing all sorts of kind of workarounds on that. So thoughts, Bill Loman?
So,
look at the camera, Bill. Look.
I'm looking down as I'm choosing words, and I'm choosing words thoughtfully.
We're gonna give you a hat with an inspirational
Be very careful, because
Yeah.
we've already gotten in trouble with Experian for disclosing.
So, look, I'm just trying to choose my words carefully. A lot of this has been driven by the fees with FICO.
Right.
And the FICOs, and then depending on the lender, there's 3 tiers. Nobody knows about it, but everybody knows about it.
Right.
Tiers 1, 2, and 3, there's a handful of companies in tier 1, a smaller handful in tier 2, and the rest of the world in tier 3.
And there's no rhyme or reason, because I have a list, and it's really interesting to me. So some of the companies in tier 1 I've never heard of. They're not doing huge volume. So it wasn't that. There was some accusation that everyone who was in tier 1 was in MBA. That didn't hold up. That wasn't the case. So there's really, oh my God, here, somebody just said that their credit reports went from $48 to 70, I missed it, $76, $78.
Yeah. Well, as a tier 1 MBA board member, I have no comment.
No, but they debunked that theory. I mean, it was thrown out there. I was hearing it a lot, and it wasn't the case.
That was APM in tier 1?
It is. Yes. But it wasn't, but that was not the case. I mean, so I went through that list with somebody line by line to decide, maybe it was you, I don't remember. Anyway,
no comment.
And it was not, there was no correlation. It was not.
And unfortunately, this is a fee that's going to get passed on to the consumer.
Yeah, totally.
And it's not an insignificant raise. The percentage raise is high on credit reports. And there's really no rhyme or reason, like you said.
Yeah, I've heard of small shops getting hit with $100 credit report fees.
Right.
It's like, wow.
So I'm
Incredible.
seeing some of the wholesalers come out and say, well, they have some workaround for the fees. And basically, you got to pay for it somewhere. So it's either being
Sure.
paid for in your pricing, it's being, they can tell you they're paying the fee, but you're still paying the fee. The consumer
Absolutely.
is still paying the fee. So in an environment where, rates go from 3% to 7 3/8 in like 13 seconds. And then now we got credit report fees going through the roof. FHFA is jacking their fees up because they're multi-billion-dollar profits every single quarter, even through this mess. I cannot figure out how they keep saying, oh, and then they'll audit us and like nail us for having a flood cert that doesn't identify the flood company correctly, and then we're in trouble. Like, I don't get it. Like, it doesn't make sense. Do you have any? No? Okay.
Look, it doesn't make sense. It has the fact that it affects certain lenders differently than others.
Yeah.
Is a bit odd. The fact that it's not volume driven. I mean, I guess to a certain degree, we've all been used to seeing certain volume related discounts. But it's kind of a head scratcher.
It's a head scratcher. It certainly is. All right, so let's just talk about volume in the first quarter, because you know what we just figured out last year, Bill? We figured out that all of the projections for what the heck was coming were complete bupkis. That's my semi-politically correct way to put it. There's another word in my head. You can only imagine what it is. So first quarter, NBA came out and said that what they're expecting is that volume will be down 15%-ish from fourth quarter.
Mhm.
And then second quarter, we should be up 40%. It should be better getting, as we move through spring and summer. And we have some other people who are projecting the same thing with what they're analyzing all the inflation numbers, et cetera. So we should be in better territory in it shortly. Let's go with shortly.
Yeah. I can make a case for optimism in 2023.
Look at you.
And look,
well, you hit bottom, there's only nowhere else to go.
Yeah, that's true. Although I will say, I think as we navigated the second half of 2022, we were all looking at and going, where is the bottom and have we hit the bottom? And because Q1 volume is projected lower than Q4 than what the industry did in Q4 of 2022, we still haven't necessarily quite hit the bottom. So, in my case for optimism, there's a couple things that I'll say. So one, that's exactly right, Audrey. That's what, the projection is. So up, about, over 40% in Q2 and then staying relatively flat. So, the volume projections were off in 2022. I was looking back at 2022 and MBA and Fannie Mae had projected that interest rates would end the year plus or minus at 4%. And that was wrong by about the third week in January.
Yeah,
and then
no one got that right. No one.
More and more wrong.
And yet they still hold on to that projection sometimes.
So look, I think, as far as interest rates are concerned for 2023, look, and I'm not good at projecting this, but I'm just going to make that case. I think, we know there's going to be further rate increases from the Fed. I think a lot of that has already been priced into mortgages because the Fed has telegraphed their punches for their intentions in 2023. I think it's already priced in. So when you look at mortgage spreads, and a mortgage spread is quite simply the difference between the 10-year treasury and a 30-year fixed rate mortgage. And if you were to go back like 20 plus years and look at the typical mortgage spread, it's about 150 basis points. And the difference between the 10-year and a 30-year fixed rate mortgage. Right now, it's 300 basis points. So the spreads are wider than they've ever been, in part because the financial markets are already pricing in what they anticipate to be future, rate hikes. already pricing in volatility risk, because all we've seen in the last year is crazy volatility in the financial markets. If the volatility slows down, simmers down a little bit, and mortgage spreads go back to historical spreads, you could have no movement in the interest rate in the financial markets, and mortgage rates could compress and get back closer to that 150 basis point spread. So that's, we don't need rates to go down in 2023. We need them to stabilize. If they stabilize, mortgage spreads will tighten, and we'll get back, to a maybe, a better interest rate environment. And look, I'm not an economist, but in just looking at that data, you can make a case, for that kind of optimism. And look, volumes are way down right now. I mean, half the world is either getting snowed in, flooded in, hurricanes in the fourth quarter. It's like, this is all, we're going to come out. I think we're going to have a good spring buying season, but
Okay.
The next couple months are going to be slow.
So not to bring up, a possible cloud looming in the forecast, but Wells Fargo has gotten completely out, is getting out of correspondent and is selling off their servicing. Okay. So, I mean, my initial reaction was, oh my God, they're such a pain in the wazooski, like good riddance. Sometimes I can get the same rate with Chase and not have all the headaches before, during, and after a transaction. Like,
Yeah.
great. Okay. So what? We adjust. No big deal. But then some wise sage brought it to my attention that Wells Fargo has, what was it, $1 trillion in servicing? A trillion. That would be with a T, people.
Yeah.
And they're going to sell that off. And what impact will that have on the market and potentially?
So now I'm going to put my pessimism hat on. So I can make a case for optimism, and I can make a case for pessimism. So, and we touched on it a little bit earlier when you're talking about City National Bank. Look, I don't think it was any surprise that Wells Fargo got out. They've been, hinting at this for
Not the first time they've done it.
And yeah, it's not the first time that they've done it. That's right. So, no big surprise. And we saw, our data at, American Pacific Mortgage. I'll use jumbo volume as an example. Their volume really trailed off the volume that was being locked with Wells Fargo. They were already impairing pricing. I think they were positioning themselves to do this, and there you have it. I think as a jumbo investor, or an investor that buys loans, conforming and government loans from lenders, I think the market participants will eventually backfill that. I think that, it will cause some short-term, pain, especially, I think in the jumbo side, but the market participants will backfill that. The most challenging thing, I think, in the Wells Fargo news is their stated intention to sell off most of their servicing. They're servicing about $1 trillion worth of loans. That's over 7% of the mortgage market. And when they go to sell off their servicing, with maybe the exception of Chase, it can't be any one buyer that's going to come in and take this. Right. So you're going to see the Mr. Coopers of the world and New Res, or whatever they're called now, and all of these companies are going to use up their capital buying the Wells Fargo servicing. Anytime a market gets flooded with anything and there's an oversupply of anything, it's going to devalue mortgage servicing rights. And when you look at how a loan is priced, the value of the servicing is the most important component of how a loan gets priced in the secondary markets. So if the market's flooded, if there is an oversupply, and if that diminishes the value of mortgage servicing rights, it's going to, impair pricing for the industry. And, and that's not good. And
that's not good. Okay, so here's a question for you. So we have to imagine that Wells Fargo's servicing portfolio is pretty varied, like a lot of different interest rates in that, in their
Yep.
humongous bucket, right?
Yep.
So, I mean, how much value is a loan that they closed at 2.5% right now versus, you know, they have 5% loans that they could be selling, et cetera, et cetera. And how do you modulate all that?
Well, so a 2.5% loan, the biggest driver in driving the value of servicing is prepay speeds. And is the loan, what is the likelihood of that loan prepaying, whether
Fair enough.
prepaying is through refinancing or even prepaying through default. So
Right,
the
so all those
2.5%
2% loans, they're gonna stick on the book for a long time. They probably should be there for
should,
a
and
year.
that should be,
And so their value is higher.
yeah, that should drive a higher value. Again, though, when there's an oversupply of it, who knows? And so what I think Wells Fargo will do, and this, nobody has told me this is just, me making an educated guess. I think they're going to try to keep the servicing that they have that are in affordable areas, and they can try then to refinance those and, their stated goal of staying in the affordable markets. Or the loans they're servicing that are part of, whether they're higher wealth clients or people that have a depository relationship. And I think they're going to want to hang on to those, and everything else gets sold off. But they were the #1 mortgage originator just up until sometime in 2022, when I think Quicken and United Wholesale passed them. But
the good news out of all this, it just popped into my little head. When we go to refinance someone who has a Wells Fargo payoff, they're no longer going to get a letter from Wells Fargo saying, hey, that LO you're working with, they're not giving you the lowest rate. We can do it right now. And then they're going to not come in and swoop that out from underneath us.
Yeah, that's unless it's one of their, high wealth clients, and they'll try to keep them.
All right. Well, that's all I had to say.
No, you know what? That's it. Make a case for optimism.
I know. Well, you know what? Honestly, so
well, the other thing, I would say the other thing too about this Wells Fargo pullout is, from the public's point of view that are not in the mortgage world, they don't see the difference between Wells Fargo pulling out of wholesale or correspondent, and Wells Fargo pulling out of doing mortgages, period. So they're thinking, oh, Wells Fargo isn't doing mortgages anymore, and they're just not going to go there. And I think that's the one good news for us, at least.
But they're scaling back retail too, aren't they?
Yeah, I think they're scaling back, but I don't think they're getting out. And I think we're all kind of watching to see what and how they define that. I think they're going to look to hire loan officers in underserved markets to meet some affordable missions that they have. And I think their high wealth bankers are going to still provide, jumbo loans to their clients.
I think that's going to be interesting to watch, because they've never exactly been known for their, how shall we put it, flexibility, which is often required when working with people who are, in the underserved category. So, so I don't know how successful they'll be with that. I guess we'll just watch and see.
Well, and you're right, because, what's the most prominent underserved product in the industry is the FHA loan. And I don't think they're thrilled about doing FHA loans just because of the, negative publicity over the years when they got stung with the False Claims Act. And that, so, they could be setting themselves up, if that's their product of choice, for further fines.
Well, okay. I was about to make some snarky comment about something, but I guess I'll skip it just this one time. This is the one time I'm going to pass on that. Okay, so let's just mosey on into delinquencies, which are still hanging in there and not so bad. Ticking up a little, but not bad, right?
Yeah, I would say yes and no on that.
Okay.
So,
lead us down the path, Bill.
Okay, so, conforming loans, absolutely right. When you look at year over year, a year ago, and by the way, delinquency numbers are a little bit late in reporting, so I think I'm going to be quoting November delinquency.
Right. That's
November 2021. Conforming delinquencies 3.8%. December or November of 2022, 2.8%. So a whole point lower. And that's where you're spot on. FHA is a different story, right? And this goes back to what we were just saying with Wells Fargo, whether it's underserved or some of the, you see lower FICO scores and no skin in the game equity in an FHA loan. Same time frame, November 21 to November 2022, FHA delinquencies 3.75% in 21, 5.25% in 2022.
Wow, interesting. That's starting to shift.
So that's where oh shoot, I mean, I guess you go down a whole rabbit hole, and I'm not an economist, but it just feels like today, when we look at economic news, as it relates to us, good economic news is bad and bad economic news is good. And I feel like we're living in the upside down right now.
It's always been like that, right?
Yep. And
Yeah.
so if at some point, we hit a recession, which I think we likely will, when it's a matter of whether it's going to be mild or not, keep an eye on that FHA delinquency number, because that's where it's going to really be impacted. And that not only impacts, it has a negative impact on the borrower, that can really negatively impact lenders.
Yes.
Because when a mortgage company delivers a loan to Ginny, and the borrower is late, the mortgage company has to advance those payments to the bondholder. So if you have delinquency starting to creep up, it could materially impact lenders for the servicing advances they have to make.
Right. Well, so with that, servicers have very much been tasked with keeping borrowers in their properties, if at all possible. So, I mean, when we've had conversations with FHA and our friend Julian Joseph, who was with us recently, she just got a promotion, by the way. Did you see that?
Yes, well deserved, by the way.
Well deserved. Like, we love her. She is a force of nature. So they are supposed to be working with borrowers. FHA in particular seems to have been very creative with coming up with alternative products, etc. So, maybe there's a little cause for optimism and they'll work some of this out. Yeah. Yeah,
I absolutely look. Nothing will get you in trouble with a regulator today more than your servicing practices and foreclosures that could be avoided. And lenders need to avoid foreclosures at nearly all costs.
Right. Right. So again, for us, our messaging to our borrowers, we should be reaching out to people and making sure that they remember, and we preach this all the way through lockdown and COVID and moratoriums and all that. Make sure you're telling your borrowers that they don't just go bury your head in the sand and avoid your servicer. If you're having a problem, let them know and ask them to work with you. I mean, and let your borrowers know that that's the case, because there was a lot there were issues during lockdown because borrowers really were afraid of their servicers. They thought it was like 2008 all over again, and 9 and 10 and 11. And so it was an issue where you'd have people who were delinquent when they could have just been in forbearance.
Yep.
And they weren't. So again, that's our job. Get the message out to people so they know that if you hit a problem, it doesn't necessarily mean you're going to lose your house. Do something.
That's great advice to everybody, because I think, if the borrower is cooperating, working closely with the servicer, the likelihood of foreclosure is very slim.
So are the forbearance rules from COVID still in effect going forward here?
I don't think so.
No, I don't think so either. Okay. And on the, speaking of debt, so credit card debt. So credit card debt is now 35%. 35% of people have credit card debt and are carrying balances versus 29% a year ago. 43% don't even know what their rates are on their credit cards. So make sure that when you are talking to your borrowers about, does it make sense? Like, should you refi? Should you not refinance? Make sure you're asking them what their interest rates are on the other debt that they have. So for instance, I got a call yesterday from a client who has something going on, and I said, send me your statement so I can see the rates on them. So that can help drive the decision on what is the best way forward. It is a time for us more and more, be an advisor. You're not transactional. You are not the push the button guy at this, or a person at this point. It is literally about, you have to have more value than some online anonymous person. And this is your time to shine. So do it.
Yeah,
Right.
I bet if they don't know what the interest rate is, it's 28%, so, or more.
Well, and I think that's, the trusted advisor part is so important because, look, we started this call talking about the cash out fees,
Yep.
right? And, I don't think we can let cash out fees get, the higher cash out fees get in the way of being that trusted advisor for all these people that are running up credit card debt right now. And I think the other thing is you're seeing an emergence for independent mortgage banks now getting access to and coming out with home equity products that are, way more favorable than the whatever, 28% credit card or whatever it is. So, I mean, I think that's going to be a big part of all of our companies' originations, or a bigger part, if not a big part, than historically it's been, is the second closed-end and open-end HELOC products.
Well, and we're seeing products where LOs can actually get paid to do a HELOC. Like, we've always done those as a for free. I mean, the company would make a tiny little bit and then we were getting zero. And now that's changing a little bit, which is interesting. But make sure that you are looking down the road for your borrower and have an exit plan. And also look at blended rates and see what makes sense, what doesn't make sense, et cetera. Because
So
we're
here's the
expecting more
biggest
vetting.
thing, Audrey, you made a really good point about getting paid or not, however yellow comp works in that. The yellow comp rule does not apply to open-ended products. So if you're doing an open-ended HELOC, your company may have a different position on that, or your company may choose to treat it the same, but from just a regulation perspective, LO comp rule does not apply to open-ended credit products.
Yeah.
Well, in the history of me being in this business, which is me and the Tyrannosaurus Rex were on Walking Earth at the same time and doing HELOCs, and I've never gotten paid on a HELOC, not once. So it's nice to see a little shift there, because again, it's a lot of work to do them.
It's just the same amount of work.
It's the same amount of work, and the idea that, oh, well, you don't deserve to get paid is kind of bupkis, but whatever. Someone said
Usually
they're
you
seeing
used to use it though to get another deal done. So like if you were doing the second loan in order to get the first loans, you would get paid on the first, and then it made it worthwhile to do the extra work. But I've always personally found that equity lines were a good source of sending them off to someone else who got paid on them, and then they would send you something in return, maybe someday later, maybe not.
Yeah.
okay.
Like having a good credit union in your back pocket.
Yeah, okay.
They got paid and got credit for their equity lines, but they couldn't do everything, so they would send you stuff in return sometimes. Sometimes they wouldn't.
Okay, so I had a conversation with a realtor, and Kevin, I don't know if you remember when this was. It was like a year plus ago probably. And they were talking about renewing their E&O insurance, and that they were having some issues in their conversation with their E&O company, that there were a lot of lawsuits that are starting to happen because realtors had, like gone off the charts and had, how do I put this? Okay, let me just read you the headline. That's better. Lawsuits from 2021 to 2022 increased 9%, which they expect that number to increase going forward. And what has happened is buyers are saying that the realtors did not advise them correctly on values, and they're claiming that, they should have some sort of recourse. So realtors and mortgage professionals are being sued over the property, the values and the prices that were being promoted the last few years, now that they're realizing that maybe they were a little slightly inflated, slightly. So the messaging here is be careful, be really careful. So especially in light of the fact that FHA now is allowing people to be the lender, do the loan, and be the realtor on a transaction. So when you're doing that, I mean, I get it. People want to get paid, but it's really hard to be objective if you have that much invested in a single transaction. And then also making sure that you're advising your client properly always has to be paramount. And so now that we're seeing that lawsuits are starting to happen, you don't want to be part of that. So be really careful. If it seems too good to be true, maybe it's too good to be true, but it just be careful. Be careful.
Yeah, be careful what you wish for, right? And like you said, Audrey, I get it. An opportunity, especially when all of our volumes are down, to have an opportunity to make money. When there's not that clear distinction in, the duties, you are so susceptible. At a time when you're susceptible to begin with. I mean, and now it's kind of doubling down on that.
Yeah.
And so
quadrupling, actually.
Yeah, right. That's exactly right, Kevin. So I wasn't necessarily a fan of this mortgagee letter that came out in December. We'll adapt, and lenders need to be smart about it, offer training, and protect your folks, protect your loan officers from.
I've always heard that in the past, the reason they wouldn't allow lenders and to be the realtor on the same transaction was they felt that you had too much control over your client. And it really exposes you, because the onus is on you to show that you didn't mislead them, or you didn't lead them down the wrong track, because there's not someone else in the transaction that could also guide them in the right way.
Yep. And yeah, one of the concerns I think that we have to look out for, not anybody on this call, but when you're doubling or more the amount of money on a transaction, the incidence and opportunity for fraud,
right,
is something that the industry needs to watch out for.
Any insight into why FHA decided to make this shift all of a sudden?
It's funny you say that. I was on a call with Julia Gordon, the commissioner of FHA, and Julian Joseph, and I asked them, and because I wasn't a fan, and they felt that there was a lot of ambiguity. There was a lot of, it was probably the most asked question they would get through them, so they made the change. And I was like, doesn't seem like good enough reason for me.
Yeah,
that's what I'd heard, and it just felt a little weird.
Yeah,
weird, shall we? Weird.
Yeah, I mean, I feel like a lot of us, that have been advocates in the mortgage space. I think we've spent a lot of time trying to get FHA and regulators to do stuff. And I said to them, I was like, I'm shocked that I'm sitting here trying to get you to not do stuff in this particular case, because it's counter to what we've all done, in our advocacy roles.
Right, exactly. Okay, so just a reminder, this week has it's a shorter week, but it has a lot of mortgage things or news happening. So tomorrow, Wednesday, we have PPI coming out, so that will be interesting, and a 20-year auction. Thursday, we've got debt ceiling. Friday, we have existing home sales. So Bill, let's talk about debt ceiling for a moment, shall we? And the potential impact that it could have on our markets.
Man,
nice softball, Bill. Really nice.
Well, so
hey, I gave him a heads up on this one. Okay.
Yeah, and I said I didn't know. Don't ask me that.
I did not. He did not. So full of crap.
Look, I just any news that has volatility, I fear is not going to have a positive impact on
rates
in the short term. And there's some things in some of the economic numbers that maybe historically, when this was bad, it meant good. It feels like now it's like everything seems to be working against us in this volatile period until, maybe things settle down a little bit.
Yeah. Well, nothing's ever stable, right? So
Yeah, I guess it's relative. I don't know.
no, I talked about this the other day. I found this podcast from Tim Brahim, who's very well known in the mortgage industry, from 2016, December of 2016. And he was talking about this. I mean, literally the conversation is the same. Oh my God, rates went up. My God, there's no refi. Oh my God, the sky is falling. Everything's going to HE double toothpicks. What are we going to do? And so, okay, maybe he was less dramatic than that, but that's more boring. So anyway, the point being, we are constantly in these cycles. We forget that we go through this all the time. The rates go up, the rates go down, the market is this, the market is that. Like, all you need to do is focus on how the hell am I going to close a loan and move on from there. And don't let all this extra noise drown out focusing on production. And by the way, I'm saying that to myself just as much as I'm saying it to anybody else, because last year was rough. I mean, it was hard. But you get through it. You get to the other side, you have to hang in there.
Focus on what you can do and just do that. Ignore what you can't do and don't complain about that.
And be super happy you were not working at First Guarantee Mortgage, because the bankruptcy judge just approved the class action lawsuit for those people. I just find that interesting. Like, FBI is searching search warrants on, leaders of companies' houses. Like, there's some gnarly stuff going out there, and we're not dealing with that. So hallelujah.
Yeah, you know what? I mean, so Audrey and Kevin, that's just great advice that I think we all need to hold each other accountable to, or remind each other of, that this is a cyclical business. There's always ups and downs, and the successful loan officers, branch managers, companies, it's how you navigate those transitions, getting from the bottom to the top, or the top to the bottom. It's he or she who navigates those transitions best are the ones that are going to gain market share. And I think that's the other thing. I think we got to measure ourselves not on comparative volume, because it's going to be way off. And we just talked about data in 2023, and volumes are going to be off. Measure yourself on market share. Are you growing your market share?
Right.
Whether you're a company, a branch, a loan officer, it's a market share year, not a volume year.
Right. Okay. So we have a question here from Alex, who is asking, who are your favorite jumbo lenders for the brokers of the world? And the answer, I think that is in flux right now, because like, we liked Union Bank. They just went away. They were a good broker option. And if you were a broker and you were sending loans to Plaza, for instance, they were using Wells Fargo on the back end as well. And now that's gone. So I think there's this transition right now. I don't have the answer on where the best broker jumbo is right now, but if you guys know, let us know, and we'll share that with people so that we are able to expand our options and make sure that we have some way to compete against the banks. But from my perspective on jumbo loans, our best way forward has always not been rate so much as they can't do your loan. We can. So focus on that. Like,
right.
That's nice that you have. I always find this interesting. So, and it's happening a lot in the non-QM world, as a matter of fact, right now too, where you've got lenders who are saying, oh, we've got this great rate. It's amazing. It's so much lower than everyone else. Well, meanwhile, they've got a ton of loans they can't sell, and they're in deep doo-doo. But the other part of it is they've tightened their guidelines to the point where you can't get the loan done there. So they offer the rate, but they can't close the loan. What the hell good does that do you? Oops.
Or they're throwing a lot of hidden costs. Like, I had one, I went back to the client after I lost the deal and confirmed that, hey, how was the deal better than ours? And when it came down to the end of it, Wells, I forget, it was Wells or B of A did the loan, but they made them pay off all their credit cards, and we did not have that as one of our conditions. Not one credit card did we need to have be paid off. Well, they spent $12,000 on paying off all their credit cards. I'm like, you didn't have to spend that $12,000. You could have used it to buy down your rate, and you would have gotten a much better term from us than you would have gotten from them. But it was too late. The barn door was closed in that particular one. So yeah, it's not always simple as you would think that, oh yeah, they got a better rate, their terms are pretty bad, and they cannot close a loan at the big banks in under 30 days to save their lives. It's not even possible. They will to reject the loan if it's going to close in less than 30 days.
Yeah, and I want to touch on non-QM. And so, look, we do non-QM. Kevin, I know you and I were talking before. You do non-QM, and I think there is a place for non-QM.
Mm-hmm.
I think every loan officer, branch, or company, you need to make sure you're dealing with the right partners.
Yep.
You know, we've seen what has or can happen if they lose their liquidity and they can't fund your loans, and whether it's financial risk to companies, whether it's reputational risk to you. You got, just make sure you're dealing with the right people and and have valuable partners that you're doing business with, not some, oh, I heard they're good, and just sign up with everybody.
Right, because the other thing too about non-QM I've come to learn is chasing rate with non-QM can be devastating, because the ones that have the low rates in the non-QM world sometimes are really pushing the envelope just a little bit too far, and those are the ones that suddenly disappear on you in the middle of a transaction. Versus
Market runs
higher.
away from them.
Yeah,
When the market runs away from them, that's where they're not going to honor locks, or they're so deep underwater. And we're still from time to time hearing rumors about this one or that one, and whatever liquidity
they've heard them all.
they may have. Yep.
It's crazy. We don't even talk about the rumors because we don't want to make it worse. And until it's done, it's not done. And then we've got some places that you're like, well, they should have been dead 4 months ago, and here we are, and they're still kicking. I don't know why or how. And you would think at some point it will end, but who knows? Maybe they'll have some genie pull something out of somewhere and fix it. You never know.
Somewhere.
Okay. So, do you think, okay, at this point, we have a question here from Jay who's saying, does that mean we might, that there might be more servicing opportunities for someone? Do you think it's a good time for a company to be servicing their loans, or not so much? Okay, never mind. It's fine.
No, I mean, I think we're all trying to figure that out, Audrey.
yeah, no, it's a challenging question.
Well, look, I'm skeptical because of if there's a flooding of the market, that it's going to drive down values. And if you're going to do it, you gotta retain it and hang on to it for a long time, and let the market, absorb this sale. So, you'll see companies, hold on to their servicing, and then maybe sell, do bulk sales and try to get a trade on that. I think if you're going to retain servicing now, you got to be in it for a while, until the market flushes through the flood of servicing rights that Wells is going to be putting out.
Gotcha. Okay, so I saw an interesting MailChimp survey that kind of goes against what we've all been doing recently. So they were looking at conversion rates, and they were trying to figure out the most effective way to communicate with borrowers, etc. So number one way to communicate with a borrower, in person. That we've been joking around for almost 3 years. They have to wake up in the morning, take a shower, put on clothes that don't stretch, and go meet people in person. Okay, so MailChimp has now confirmed what we thought we knew, which is get out of your house and go meet someone. Second is a phone call. Third is snail mail. And fourth is email. So these email campaigns that we have going are very ineffective in the big, grander scheme of things. And it's that personal touch that really, really cements relationships and makes them not transactional. So again, this is your Auntie Audrey going, get out of your house and go meet someone. And the other thing that I thought was interesting, and I learned about it when I was in Florida at the NAMB conference, because I met a bunch of new people. They had never been to a NAMB event before. Oh, really? How did you find out about it? They had sent a postcard. Can you believe that? A postcard in the mail. There were people there because they got a piece of mail delivered by the U.S. Postal Service, presumably. So again, think outside the box, guys. This email thing, the sitting at home, waiting for your phone to ring, sending an email, thinking that's going to make someone fall in love with you. No, it's not. So just thought I'd share that with you because I thought that was interesting. And also I have a note here that I also wanted to share. Corp CPI has gone from the high of 6.7% down to 5.7. Headline has gone from a high of 9% to 6.5%. And while those inflation numbers are still gnarly and we don't like them and they are not great, they're so much better than they were. So focusing on the positive. There we are. And what else you got, Bill?
You know, I think the biggest thing, Audrey, is have that positive attitude. There is a case for optimism. Grow your market share. I think this is going to be a year of haves and have-nots. And I think if you do that, you'll be one of the haves.
Yeah. Well, we have a couple of comments in the chat from people who are confirming email requires a follow-up either in person or by phone, and that you should be sending postcards to past clients monthly and then call them 3 or 4 times a year. And we did hear from Carl White in Florida, and he is going to join us one day soon as I call him and get him booked. So somebody was saying that Carl White has done a lot of testing and says postcards in the mail are by far the most effective other than calls and in person. So that it's really, again, as you're looking for what do I do in 2023, we're gonna be talking a lot about that, because a lot of us got through 2022 and we're okay, but another year like that and we'll be, you know, God knows what. So just a little reminder of what's coming up. First of all, the recordings are either on our website, www.mortgagepros411.com, or on our YouTube channel. They link to our YouTube channel, where our good friend Jason Bellevue and Ben Bellevue are responsible for helping us keep that updated and making sure that if you missed the live recording,
I get to watch you forever, Bill.
Yeah, I know. Yeah, everything you said, it's out there forever. Anyway, so with that being said, next Tuesday we have Dan Habib with MBS Highway.
Yeah.
I had a flash.
And then after that,
I was worried I was saying the old company. I did not. Okay, Dan Habib, MBS Highway. And then following week on January 31st, we have Dr. Elliot Eisenberg, who we love, our favorite economist, who will guide us through what the heck is going on that we've missed and what is coming up. Oh my God, you're both silent at the same time. That's
I'm writing notes to make sure that Elliot is awesome. We've had him at company events. We always take the opportunity to hear what Elliot has to say.
We love him. And you never know what he's gonna say. He's another one where it's like, just wait for it. Wait for it. By far my favorite explanation of the Fed rate increases and how the timing takes to unfold. Oh my gosh.
You may need to edit what you post, you know, the recording you post. There's liable to be something mildly inappropriate.
Yeah, we're not editing that. Let's leave it in.
It's more fun.
You know, we need to have more keep it real in our industry.
Yeah. I do recommend going back and looking for Elliot's YouTube video.
God, it was one of the funniest things. It was one of the funniest moments we've ever had on the show, which I thought I was going to fall over and die. Anyway, from happy and laughter. All right, so we have some thank yous here, Bill. Thank you for everything today. We really appreciate your insight. Bill is very instrumental in MBA's workings, which is, you know, it's really important. So we thank you.
I thank you guys. I always learn something, either prepping for these calls with you or being part of the calls or the questions. So it's, you know, right back at you.
Thanks, Bill. All right, well, tell your friends. And if you're listening and you enjoy this and get something out of it, share it with your friends too, please. So with that, we will see you next Tuesday at 11 a.m. Pacific time. And wherever you are in the country, we'll look forward to that, and have a wonderful week, everyone.